with chaos at the New York Stock Exchange.
Get back in there at once and sell, sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Financial Advisor at BIG Investment Services. That's BIG, Booth Investment Group. We're a full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come, trying to keep you up to speed with you and your money and the competition informed. And we're glad you're with us today. It is Friday, March 1st, 2024. A little shout out to Jake, the boat doctor, tuning in, and Wayne and Carol and Chandler, Mr. Logistics. Glad everyone's tuning in to the show. We appreciate that. Glad you're getting some value out of it. Let's go ahead and talk about the markets. A good week for the markets. Dow Jones Industrial Average was down 0.1%. But remember, folks, the Dow Jones Industrial Average is statistically irrelevant. Pay no attention to the Dow Jones. Let's look at the other ones. S&P 500, that is what we want to pay attention to. And that was up 0.9% on the week. NASDAQ Composite up 1.7% this week. And the Russell Small Cap Index finally getting some love this year, up 2.9% this week. And that's big news. You know, there's a grossly overused saying attributed to Wayne Gretzky, says, don't skate to where the puck is, skate to where the puck is going, right? That last year and a half, the puck has been at large cap tech and artificial intelligence related stocks, which I'm glad we've had our share of them. They've done absolutely fantastic. They've been on fire. But, you know, I think we're really starting to see maybe this market move towards broadening out. I think the puck is probably headed towards things like financials, energy, high quality small caps. I think we can start to see more capital flowing through to these areas, and we're positioned for that. I mean, don't get me wrong. We still have our large cap tech, but we really have rounded things out very nicely with a little bit more exposure on these areas that have not really been shown the love over the past year. I think there's a lot of opportunity there, and that's why we want to kind of concentrate on those areas a little bit. I mean, for example, look at Apple year to date. Now, we don't own Apple. Bought it years ago for $40. We sold it around $130. But you look at it right now, it's down 6.7% year to date, negative. All right. The S&P is up 7 and Apple's down 7. So maybe the large caps are starting to get a little tired here. And I think it's good to be spread out, focus on some other areas. And that's what we're doing. Before we jump in the sectors, look at some other things. Long-term bonds as measured by the TLT, it is actually up a little bit this week, of about 0.6%. And touch base on that real quick. Why? So money's gone into bonds. Bonds have gone up. Rates have come down. Why has that happened? The economic data has been a little bit on the weak side. Okay. So ISM's manufacturing numbers down 16 months in a row, down again. Michigan Consumer Sentiment Report, less than expected. The PCE numbers, that's an inflation measurement that the Fed really pays a lot of attention to. It came out as expected, and year over year was in line with expectations, but the month over month was hot, as was the CPI and the PPI last reported last month. So there's still some concern. Inflation is still a little bit of an issue there. Putting all this together, some of this economic data in whole, when you put it all together, is leaning towards the negative side. And the market likes that. I know it sounds odd, right? Why would the market like the economic data to be negative? Because the market thinks that gives the Fed support to cut rates this year. The market wants to see the Fed cut rates. Weaker economic data makes the market believe the Fed's got that covered to do so. I think they'll do it as well. I just don't think they're going to do it anytime soon. I think you're looking at last half of the year, maybe 2 or 3 cuts at best. Other things, the volatility index still staying rather tame, 13.5. It was down about 1.5% this week. So the VIX, 13.49. That's a nice place for the VIX. That looks pretty good. And when we take a look at the sectors, interesting this week, the defensives did nothing. The utilities were down 0.4, staples, consumer staples down 0.4, healthcare, another defensive area, down 1% this week. And we really saw money headed towards things like retail sales up 3.2, semiconductors up 5.7, consumer discretionary 2% to the upside this week. So even energy up 1.4% this week. So that's what we've been seeing. Defensive's not doing quite as well. And then metals, gold was up 2.2%. First time this year, it has actually caught a bid, and it's just turned positive on the year, 0.9%. And silver up 0.8% this year, but still down year to date. It's up 0.8% for the week, but still down year to date. So what's moving markets? Well, I mentioned a little bit about the weaker economic data actually being a positive for the market. Earnings have been coming out. They've been fine. They've been nothing to be alarmed by there. I think earnings have been average. It's just been an average earnings season, but average is better than below average for sure. So that's all looked okay. I've got some concerns though. When you take a look at what's been going on with the market as a whole, it's looking a little stretched to me. Looking at some of these technical indicators. Now, the S&P oscillator, that's one that I look at a lot. That doesn't look too bad right now, but the Tom DeMark, I've talked about him before. DeMark is fantastic. His indicators are really, really powerful, really on point in most cases. 9s and 13s are usually turning points in a market. A 9 and 13 when the market's going down is usually shows exhaustion and the market starts to turn the other direction. 9 and 13 when things are climbing, a lot of times shows exhaustion to the upside and the market turns direction. Well, we got a 9 a couple weeks ago and we just got a 13 today on the S&P 500. So that's something that kind of has my attention. And next week, we get another CPI number. We'll also get a jobs number at the end of the week. So again, there could be a catalyst here in the very near future to shake things up a little bit. So what have I been doing? Well, I've been trimming. Marcia's favorite word, trim, 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 triminy, triminy, trim, trim. And when you trim and you take some of that money and you can get yourself a shiny black EV. So congrats on that. Anyway, I've been doing some trimming. I trimmed Eli Lilly. Love the stock. I think I mentioned last week I was planning on doing it. We bought it for $330. It hit $770 this week. And I trimmed it back. Didn't sell it all, but man, this stock is ridiculously expensive. It's also the leader in this space right now, so it can go a lot higher. Don't get me wrong. That's why I didn't get rid of all of it. But, it's trading at a valuation that resembles more of a tech stock startup than it does for an established pharmaceutical company like Eli Lilly. So although I think it could still go a bit higher, I went ahead and trimmed that back. I trimmed some AMD. I talked to Katie Stockton. If you ever watch CNBC, you'll see her on from time to time. Great technical analyst. And I reached out to her and said, Katie, what are you thinking about AMD? It's getting stretched. We paid $67 for this stock. I bought some more of it in September, a few months ago for $97. It hit $202 today. It's really just getting, I think, stretched a little bit. It can go a lot higher. They're doing the AI chips, and this is a big thing right now, but the stock is expensive. So she said it looks like it's getting close to exhaustion, probably into next week. So I did some trimming today. I might do some more early next week. Also looking at Facebook, but the indicators that I'm watching, and I also ran this one by her too, Facebook looks like it still has gas in the tank. I don't know if I need to be worried about that one just yet. I think that it can go a little further, so haven't pulled back on that one yet. But I've been trimming, been doing this for a while now, raising up some cash. And the reason for that is because the market is probably likely to have some sort of pullback. And when it does, we want to be in a position to, number one, not feel the pain. Number two, to be able to step in and do some buying, which I'm anxious to do. The technicals in the market have clearly suggested that this thing's going higher over time. But in the short run, we are probably pretty due for a good 5% or so pullback to shake things up a little bit. And I think that if that happens, when that happens, we're going to step in and we're going to do some buying. Now, all that said, there's one more thing that's a bit of a concern of mine. Nick Rake of Earnings Scout. I've mentioned Earnings Scout to you before. Nick does great work, very expensive, but his work is fantastic. Look, every firm on Wall Street tracks earnings estimates. What are the estimates for this stock for next quarter? What were earnings? What are the estimates for next quarter? And they always talk about the earnings estimates and base their numbers off the estimates. What Nick has discovered quite some time ago is that the market doesn't move so much off of the actual estimates. It moves more off the delta, the rate of change. Let's say we're going through a really terrible market, right? And earnings are collapsing and they're just dropping. When earnings estimates go from really, really bad to not quite as bad, still bad, right? But not as bad. Let's say they're dropping by 10% per quarter and now all of a sudden they drop by 7%. Markets respond incredibly positively to that turn. Same with the other direction. Earnings are going up. They're going up by 5% a clip. And all of a sudden now they're only going up 2%. Markets turn and respond negatively to that type of move. So markets are really tuned in to the delta on earnings estimates more so than the actual estimates themselves. And right now, I think I mentioned this to you last week, we're starting to see this really wide gap between the price of the market and this rate of change on earnings estimates. Nick calls it the alligator jaws. And time again, or you go back over the years that I've been working with them, when the alligator jaw opens, it does close. Trust me, it will close. It always closes. The question is, what's going to close it? Is it going to be earnings accelerating in a really strong fashion, or is it going to be price coming down, or a combination of the both? Well, I don't see the catalyst to push earnings up as much as they need to go to close this gap. I think price has got to come down at some point. We need a little bit of a shakeout. And having the cash on hand puts us in a great position for when that happens. And if it doesn't, well, we'll find other places to put money to work. But I think right now, the prudent thing to do is to be prepared for a rainy day. So that's what we have done. And we did it this week by doing some trimming, raising some cash, and we're in really good shape for whatever may lie ahead. So that's what I have for you. Between now and next 3 meetings, you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Maybe it's retire a little early, take that big trip, buy that second house, or pay for college. You know what your goals are. Don't just think about them. Think big. Think BIG. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.